What's up, everybody? I'm Joe Brown and this is Heresy Financial. And today, man, it is a bloodbath out there for commodities and precious metals. So today in this video, we are going to look at number one, what is driving the sell-off? And number two, is this an opportunity to buy the dip? Ready? Let's dive in. Commodities, precious metals, and miners have been falling in price at a faster pace than I've been falling in weight this year on the carnivore diet, with gold down about 2% again today. After yesterday, it's back below 1800 at about 1770 an ounce right now. Silver is back down under $26 an ounce again. Broad commodity baskets are down 2 to 3%. And take a look at this chart. You know, I slam CNBC a lot, but man, this is a great visual of how far and fast commodities specifically have been dropping just this week alone. Meanwhile, tech has been seeing massive strength, huge gains today. We're seeing breakouts to new highs or breakouts of channels in many names, and some of the big movers, Shopify, Nvidia, Adobe, Amazon, are up 2 to 6% today alone. So what is going on here? Well, there are a couple of things driving this. Number one, the market is bracing for the impact of a tighter dollar. This is also the reason that the dollar index, which is the dollar measured against a basket of other currencies, is also up. It's almost at 92 again. It's had a massive jump the last couple days. So if the Federal Reserve is going to raise rates 2 times by the end of 2023, which is what they said they were going to plan on at their meeting yesterday, there's a good chance that they might start winding down their asset purchases by the end of this year, and sometime next year they might even completely stop their asset purchases. That's in stark contrast to what the Federal Reserve is doing now, which is buying $120 billion worth of assets, that's mortgage-backed securities and treasuries, every single month. Now, if, and this is a big if, but if they reverse course, that's going to be taking dollars out of the system. Again, the exact opposite of what they're doing right now, which puts dollars into the system. That's why they're doing this. And we can go back to basic supply and demand here. When you have more dollars compared to everything else, that reduces the value of each dollar compared to everything else. It's just a fancy way of saying that more dollars equals higher prices. You need more dollars to purchase the same amount of stuff. Conversely, less dollars in the system compared to everything else again, it increases the relative value of each dollar compared to all the stuff. You've got less dollars equaling the sum total of all the stuff, meaning that if you want to purchase some of the stuff, it takes less of the dollars than before. Again, that's just a fancy way of saying that less dollars makes things cheaper. So that's the first thing, is the market anticipating the potential of that happening in the future. But that's not the whole story. There's a second piece of this story, which is actually China. And a couple of days ago, China announced that they were going to be releasing reserves of some key commodities that they've been storing up and holding for a while now. In fact, this is the first time since 2010 that they've done this. So basically, coming from China, there's a bunch of new supply of commodities hitting the markets. Again, going back to basic supply and demand, when you have more of something, that decreases the relative value of each unit compared to everything else. So when you have a massive spike in the supply of something, it makes that stuff cheaper. Again, obviously all else being equal. So given these two drivers, with China introducing new supply onto the markets, and with the potential of the Federal Reserve tightening and pulling money out of the system, either later this year or next year, is what's going on right now a buy the dip opportunity? Well, in my opinion, yes, but it's not a back up the truck moment, not yet. I anticipate that we are very likely to experience some more volatility just like this going over the next couple of months and even the next year or so, with more big drops just like we're experiencing right now. And every drop, every time something like this happens, that's an opportunity to add to positions. So it's impossible to catch a falling knife. So I personally would prefer to add to positions rather than back up the truck on something like this. And here's why non-correlated positions are so key. And I talk about this from time to time on this channel, but true diversification means that your positions are non-correlated. A perfect example of this is tech today, showing massive strength. So if you're all in on silver, or all in on Bitcoin, or all in on commodities, or all in on real estate, or all in on any asset class, you don't have anything else that tends to move differently compared to that asset class for you to take some profits to buy the dip. But if you do have some exposure to tech companies right now, today is an opportunity to sell and take a little bit of those profits and roll that into something that looks like it's on sale, like commodities. Now further, I anticipate more lip service to tightening in future Fed meetings, rates. But I also expect that if they actually engage in some real tightening, if they actually raise rates, if they slow down their asset purchases, and especially if they reverse course and start selling assets, I think it's almost a certainty that the market will not be able to take it. It will spark enormous sell-offs all across the board, and the Federal Reserve will be dangerously close to risking a deflationary death spiral. And that is the last thing that any central bank wants, is to trigger deflation. So I do anticipate more volatility. I do anticipate some gains in the deflation plays and some short-term losses in the inflation plays. But I'm looking at every single one of these as opportunities to buy the dip, because there's pain, there's going to be pain short term, but this is setting the stage for what looks like, 2-3 years to 15 years down the road, some unbelievable massive gains, historic opportunities to load up on some of these things. Specifically with gold as well, there's another driver, Basel III, which lots of people are talking about. We get the implementation in June and then the full implementation of the rest of the rules in January of 2022. These should have enormous impacts on the price of gold being truly represented without having the unallocated gold positions being able to take so much of a precedence in the markets to suppress what the true value of or the price of gold should actually be. Now, as I always say, I could be wrong about this, so don't take my word for it. I don't even take my own word for it. That's why I hedge my positions. If I'm wrong and silver goes to 5 and gold goes to 800 and the dollar index goes to 120, I want to be able to win from that as well. I don't have a crystal ball and I don't invest like I do. But in summary, my long-term views have not changed at all. I don't think what the Federal Reserve said yesterday will make any difference long-term what happens here. I think that there's now a better chance than I used to think that they will do some sort of, they will try to tighten somewhat, but I think it'll instantly trigger so much market destruction that they'll instantly reverse course, double, triple down on everything they've been doing for the last year and a half, because they'd rather risk hyperinflation than deflation. If you enjoyed the video, if it was helpful to you, do me a big favor, hit that subscribe button and pass the video along to somebody you think it would be helpful for as well. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.